What the interest rates going up again? Remember all that talk earlier this year about 6 to 8 rate cuts during 2024? Well, that hasn't happened. Today, I'm going to break down what's going on with interest rates, as well as some comments from Fed Secretary Jerome Powell and JPMorgan CEO Jamie Dimon. I will also break down my thoughts in the end on what this means to homebuyers. All this and more right after this. Hi, I'm Kevin Grolig. I'm a real estate agent with Compass located in Potomac, Maryland. Thanks once again for checking out the latest video in my series, Real Kevin. Last week, interest rates exploded to an all-time 2024 high of around 7.25% to 7.5%. This was mostly based off the third bad inflation report that just recently came out for March. Bond market investors who fund most mortgage loans are convinced that the most recent inflation numbers mean that the Federal Reserve will not cut interest rates in June. On Wednesday, April 10th, the U.S. Department of Labor said the inflation rate has picked up to a pace of 3.5% above the same time last year. It's also up from February's 3.2%. As I mentioned earlier, this is the third hot report in a row. All of this talk about 8 interest rate cuts, 6 interest rate cuts, 3 interest rate cuts have all been thrown out the window. The Fed's goal is to get the consumer price index to 2% or below. This is the goal that they have placed in order to start rate cuts. Unfortunately, we seem to be moving the opposite direction. The central bank left rates unchanged in March, and that was before the latest inflation numbers show the Fed seems to be losing ground in its fight against inflation. Federal Reserve Chair Jerome Powell stated on Tuesday interest rate cuts won't occur as soon as previously thought, citing a lack of progress on cooling inflation so far this year. The Fed may keep rates at its 2-decade high level for longer as it assesses its incoming economic data. Powell stated this in his first comments since last week's hot inflation report. He also goes on to say, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy, further time to work, and let the data and the evolving outlook guide us. In recent months, Fed officials have said they wanted more confidence that inflation truly was falling back. Powell goes on to say the most recent data have clearly not given us confidence and instead indicated that it may take longer than expected to achieve that confidence. Now, to be clear, mortgage rates aren't set directly by the Fed, but by investors' appetite, particularly for 10-year Treasury bonds, the leading indicator for fixed mortgage prices. That can lead to intense rate swings. They soar on news of Fed hikes, then plummet in anticipation of a cut. Additionally, JPMorgan CEO Jamie Dimon, arguably the most famous banking executive in the United States, made this prediction in his shareholders letter Monday. Among other things, Dimon said, interest rates could ultimately reach 8%, and both a recession and stagflation are possible. In his letter, he said, we are prepared for a very broad range of interest rates, from 2% to 8% or even more, with equally wide-ranging economic outcomes. From strong economic growth with moderate inflation, in this case, higher interest rates would result from a higher demand for capital, to a recession with inflation, i.e. stagflation, he wrote in the letter. Dimon also went on to say, huge fiscal spending, the trillions needed each year for the green economy, the remilitarization of the world, and the restructuring of global trade are all inflationary. Dimon says he questions the optimism in financial markets. He said investors and traders expect the Federal Reserve to engineer a so-called soft landing in which the economy avoids a recession despite a sharp rise in interest rates in recent years. Dimon said such an outcome that implies inflation quickly returns to the Fed's 2% target rate from higher levels right now is less likely. Dimon's comments also fly in the face of the accepted wisdom in certain corners of the real estate industry. Last fall, for instance, multiple economists had predicted that mortgage rates had peaked. Some also predicted that rates would gradually drop in 2024 and even in 2025, though there was some disagreement on how far rates would drop. Alternatively, some economists have lately revised their predictions to reflect a longer period of high rates. Either way, though, agents across the U.S. had been hoping rates would fall significantly for the spring market, which is typically the busiest time of the year for home buying. Well, there you have it. How about that doom and gloom? All this talk about interest rate cuts in 2024, and here we are entering the second quarter of the year, and there ain't nothing anywhere in sight. So the big question is, what does this mean for home buyers? My take is, if you need to purchase a home and you are not only able to qualify for a mortgage, but also make the monthly payments, you should highly consider buying a home now. If today's high interest rates have squeezed you out of the market, then obviously now's not your time. And if the high interest rates have squeezed you so much that you just do not feel comfortable making those payments, then I would definitely say now's not the time. One of the reasons I say that not only if you can qualify for the mortgage, but also make the mortgage payments, you should buy now is because you're getting the double whammy. Interest rates are going up, and so are home values. I have a few clients I'm working with right now in April 2024 who wish they would have been a little bit more aggressive on the homes they found in January and February. Right now, those high prices that you would have paid back in January, February of 2024 look like an absolute steal today in April. Once again, the key is to be able to afford the monthly mortgage payment. If you can afford the monthly payment in today's high interest rate environment, you may have the option to refinance your mortgage later down the road with more preferable terms. Hey guys, unfortunately, it looks to me like high interest rates are here to stay for the foreseeable future. What do you think? Don't forget to like, comment, and share my video. Oh yeah, and subscribe to my channel. Are you watching this video from outside of Montgomery County, Maryland? If that's you and you're considering a move to Montgomery County, Maryland, and you'd like a free Montgomery County relocation guide, click the link in the description box below. If you have more specific questions about relocating to Montgomery County, Maryland, best way to contact me directly is by text 240-793-7495. Thanks for tuning in today. I wish I had better news. See you next week.